IBM stock, ticker symbol IBM. This stock is up 2.8% year to date versus the S&P 500 being down 20%. And one of the reasons why people love IBM is because of the dividends, of course. And I understand why. 4.75 dividend yield is really high. But what about the fundamentals of this stock? This Monday they are also going to announce their quarterly results, so it's the perfect time to do a fundamental analysis about this company. In this video I'm going to show real quickly what IBM does, a view at the historical returns, the fundamental analysis, the dividends, the major competitors, and in the last part I'm giving you my price target to see if they are a buy or not. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does IBM do? The company primarily sells software, IT services, consulting and hardware. The company has a robust roster of 80,000 business partners to service 5,000 clients, which includes 95% of the Fortune 500. While IBM is a business-to-business company, IBM's outward impact is substantial. For example, IBM managed 90% of all credit card transactions globally and is responsible for 50% of all the wireless connections in the world. If we check the revenue breakdown for IBM, we see that there are three segments: software, consulting and infrastructure. In the most recent quarterly results we see that the first segment, software, did 5.8 billion in revenue, representing 42% of the total revenue. Within this segment there are two revenue categories: transaction processing, which is up 31% year over year, and hybrid platform and solutions, being up 10% year over year. The second largest segment is consulting, which did 4.8 billion in revenue, representing 34% of the total revenue. In the segment we have three revenue categories: application operations, being up 40% year over year, and business transformations, being up 90% year over year. And technology consulting is also up 90% year over year. The third segment is infrastructure, which did 3.2 billion in revenue, representing 24% of the total revenue. This segment is flat year over year. The revenue categories are infrastructure, support, which is up 4% year over year, but the second category, hybrid infrastructure, is down 2% year over year. And now that we know more about IBM, it's time to check historical prices to see what happened there. Since it's a bit difficult to come up with the right set of competitors, I decided to include the S&P 500 as a benchmark, but also ACN and HPQ and Dell. On the 5-year chart we see that all stocks did beat the S&P 500 quite easily, except for IBM. In the past 5 years you had a 20% return with IBM including dividends, while the S&P 500 did return 71%, so that's quite a difference. On the 1-year chart we see that IBM returned 9.5%, while the S&P 500 has a minus 10%, ACN a minus 12%, HPQ a 15% gain, and Dell is down also 7%. On the 6-month chart we see that all stocks had a negative return, except for IBM. So that's quite interesting. IBM did return 6.8%, while the S&P 500 had a minus 16.5%. The other competitors did a minus 16 to minus 27% return. On the 1-month chart we see that IBM and the S&P 500 are both up 2 to 3%, while the others are down 3 to 9%, so that's also quite interesting. So does this mean that IBM is a buy? Let's find out by checking the fundamentals of this company. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to receive similar analysis to this one every week. And also, don't forget to like this video. Let's continue by diving into the fundamentals. IBM is a 126 billion market cap company with a 12 trading month revenue of 52.8 billion. In this graph we see that revenue is going down in the past decade. The big decline in late 2019 is because they sold off a division, so that's nothing to worry about. In fact, I think it was a smart move since they kept the growing part of the business as it seems. But definitely keep an eye on the revenue. Net income is at 5.5 billion, which gives us a profit margin of 10.3%, which is slightly above the 5-year average of 9.4%, so that's looking really good to me. It's also above the 10% minimum, but to be honest, I would prefer a bit higher profit margin for a company like IBM. so also keep an eye on this number. PE ratio is almost at 23, which could indicate that they are slightly overvalued. But later in this video I'll give you my 3 price targets based on the low, mid and high assumption, so make sure to watch until the end. Next up is return on assets, sitting at 8.7%, which is below my 10% minimum. Return on equity is at 26.9%, which is nice. But the return on invested capital, the most important number here, is at 8.3%, and this is below the 10% minimum. And to be honest, it does worry me a little bit, especially since it's below the 5-year average. So definitely keep an eye on this number. Next up is the balance sheet and cash flow statement. IBM has a total cash of 10 billion. Operating cash flow is at 11 billion and leverage free cash flow is at 5 billion. And this worries me a lot. Total debt is sitting at 57 billion, meaning they can't pay off a big chunk of the total debt. So I don't like this at all. And it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to do acquisitions, buy back shares and pay dividends. Free cash flow is going down in the long run, except for 2020, where they sold off this division. So this does worry me a lot. They also have a high debt and free cash flow isn't growing, so dividends and share buybacks might be at risk. And that's exactly what's wrong with this company. They are issuing more shares in the most recent periods to raise capital, which they use to pay dividends and pay off debt and other things. So this is also something I really don't like about this company. You get diluted as an investor because they issue more shares. Next up are the dividends, the part that people love about IBM. IBM pays a 4.75% dividend yield at an annual payout of $6.6 a share, or $1.65 a quarter. Payout ratio is at 68% and this is too high to me. You want this number below 50% and maybe in the case of IBM even lower, so they can pay off their debt and buy back a lot of shares, which will add a lot of value to the investor in the long run. The 5-year growth rate is at 3.6%, which is a bit low. But to be honest, dividend yield is already really high, and I don't think they should invest their money into the dividends, as I just told you a second ago. So I don't mind having a low growth rate here. They grew the dividends for 23 years in a row, which is quite nice. Next up are the fundamentals of IBM versus the competitors. I decided to include Accenture, ticker symbol ACN, which is the biggest company of these two in terms of market cap. Both companies have a PE ratio around 25, but nothing special to see here. IBM has a lower revenue growth year over year, and also a negative revenue compound annual growth rate. And ACN is growing at a pretty steady and decent amount. It's the same story with the net income compound annual growth rate. ACN is definitely the winner here. IBM has a higher gross margin, but net income margin, return on equity, return on assets and return on total capital are all lower at IBM versus ACN. So to me, ACN is again the winner here. ACN is also capable of paying down all their debt, while IBM can only pay off 20% of their total debt. So ACN is again the winner here. IBM has the highest dividend yield, but also the highest payout ratio. Dividend growth rate is the highest at ACN, so it depends on what your goal is, and I don't think there's a big winner here. Overall, ACN does look way better compared to IBM. The last part of this video will cover the 3 price targets that I created using the Everything Money software. It's one of the best tools out there, definitely check them out. So I'm using a low, mid and high assumption. And to be honest, it was a tough one. With the revenue growth, I expect a -3% for the low assumption. I expect 0% revenue growth for the mid assumption and a 3% revenue growth for the high assumption. Profit margin is at 9%, 10.5% and 12%. Free cash flow margin at 14, 15 and 16%. And PE ratio I'm aiming for 14, 16 and 18. Because I don't want to overpay for a company this big with some bad fundamentals. And it's the same story with the price to free cash flow. My desired annual return is at 12.5%, since I can get an easy 10% average annual return with an ETF. Right now, IBM is at $141. When I hit analyze, it doesn't look good. We have a low price target of $42 to $66 a share, a mid price target of $65 to $92 a share, and a high price target of $98 to $130. So all these three price targets tell me not to buy this company. And to be honest, I think they are in the range of the mid price target. So it has to fall in half pretty much. My final conclusion with this stock is that I think they need to change a few things. Start paying off debt and buying back shares. This will create a lot of value for the investor in the long run. And in the end, it will make it easier to maintain and increase the dividends. Revenue is something that I'm not sure about, so we need to wait to see what happens there in the coming quarters. Right now, I think IBM is a sell because they are highly overvalued based on what I see. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I'll see you in my next video.